Welcome to the deep dive. Imagine a financial pressure cooker, but instead of steam, you have billions in capital, and the release valve is just completely jammed.
Yeah, and Bitcoin is trapped right inside it.
Exactly. And this massive $1.5 trillion AI vacuum is about to turn up the heat,
Okay, let's unpack this because we recently saw a really harsh price rejection right at $65,650.
which triggered that rapid slide down to $63,393.
Right.
And I mean, that rejection wasn't just some random fluctuation. The spot market basically met immediate supply and just failed. What's fascinating here is that this lack of institutional conviction traces directly back to a shifting macroeconomic reality.
Right, because Fitch Ratings just downgraded the U.S. GDP growth forecast.
Yeah, to 1.9% for the year. And paired with that, the market is being forced to swallow the reality of a stationary 3.75% interest rate.
Which is huge because when borrowing money costs that much, institutional investors just have to be ruthless.
They really do. I mean, they are pulling their speculative risk budgets out of digital assets and pouring them directly into AI infrastructure because that's where the immediate growth is. It's like that $1.5 trillion AI spend is this massive sponge.
Oh, absolutely soaking up all the liquidity.
Yeah, soaking up all the speculative liquidity in the market. So it leaves non-yielding bearer assets completely parched, in a 24/7 trading environment.
Totally. The cost of capital right now is so high, it's forcing this brutal fight over every single dollar. And if we connect this to the bigger picture, you can see this friction actually splitting corporate strategies right down the middle.
It is literally night and day. Because on one hand, you have hyperscale data hoarding, 1,106 Bitcoin?
Yeah, specifically to buy high-performance servers.
Right. But then you look at Bitmine Immersion, and they completely abandoned that model.
Right, they pivoted entirely.
Yeah, they're locking up nearly 5.79 million Ethereum just for operational yield generation.
Which is wild. And that corporate desperation for capital, it's bleeding right into the regulatory space, too.
Oh, for sure.
Because, well, federal agencies finally classified Bitcoin and Ether as commodities, right? But state-level friction is actively hurting adoption. Like Illinois just signed a law putting a 0.2% tax on UTXO consolidations.
Which is crazy if you hold your own keys.
Yeah.
Because you're just doing basic wallet housekeeping, trying to save on future network fees, and the state steps in to tax it.
Exactly. It's incredibly fragmented.
And you'd think with all this external macroeconomic pressure, the network would pull together. But here's where it gets really interesting. They are tearing each other apart from the inside.
Yeah, the internal network chaos is real right now.
Like this BIP 110 dispute. But wait, I have to push back here. We just had $43 million lost to cross-chain bridge and hot wallet exploits.
Right, just this week.
So shouldn't developers be focused on foundational security instead of, fighting over a data limit soft fork?
Well, this raises an important question. Security is critical, but the developers pushing BIP 110 argue that arbitrary data bloat is actually an existential threat to node runners.
But the friction it's causing is massive.
It is. There is a severe risk of an August chain split here because the proposal only has 0.92% miner support.
Wait, less than 1%.
Less than 1%. And heavyweights are openly rebelling. Michael Saylor is publishing arguments against it. And Plan B is fiercely opposing the upgrade over deep censorship concerns.
So they're introducing all this operational chaos right when institutions are already looking for an excuse to leave.
Precisely.
So what does this all mean? We're just stuck, right? The market is in this defensive range between $63,000 and $63,700.
Yeah, institutional conviction is super fragile right now because of these converging threats.
Right. The macro squeeze, the AI liquidity vacuum, state taxes, and this internal chain split chaos.
It goes right back to your jammed pressure cooker analogy. The heat is up, but the capital has nowhere to flow easily, and the internal mechanisms are literally grinding against each other.
Exactly. Which leaves you with one final thought to ponder as you watch the charts this week. If macroeconomic liquidity remains entirely choked off by this relentless wave of AI investments, will desperate corporate treasuries eventually use their massive Bitcoin holdings to force network consensus?
Taking power away from traditional miners entirely.
Exactly. Keep an eye on it.